In recent years, economic forecasts have fluctuated between extremes, leaving both experts and the general public in a state of uncertainty. A few years ago, everyone was bracing for a market crash, predicting imminent economic doom. Fast forward to the present, and the conversation has shifted dramatically. Now, many believe the U.S. economy is headed for a soft landing, with no recession in sight. But is this optimism warranted, or are we ignoring some critical warning signs? As the saying goes, only the paranoid survive. In the world of finance, overconfidence can be dangerous. In this article, we explore the current economic landscape, why some indicators suggest a recession is inevitable, and how a few dominant companies are masking deeper economic problems. The truth is, we've never been in this exact situation before, so predicting what will happen next is no simple task. The U.S. Federal Reserve's aggressive interest rate hikes between 2022 and 2023 are unprecedented. The Fed raised rates by nearly 5 percentage points in a short period, a historical outlier. But what does this mean for the economy? To understand this, we need to consider two factors: the Fed's balance sheet and the money supply, or M2. Historically, both metrics grew steadily. However, during the COVID-19 pandemic, the Fed flooded the market with trillions of dollars, an act without precedent. This sudden infusion of cash created an economic environment we've never seen before, making it difficult to predict the future. Many analysts and business leaders confidently argue that this situation will stabilize, but on what basis? There's no historical case study to reference, so any prediction is speculative at best. The reality is that nobody knows with certainty what will happen next. As we approach the 2024 U.S. presidential election, economists, CEOs, and financial analysts are divided over whether a recession is on the horizon. The Federal Reserve staff projects a 0% chance of a recession, while other sources tell a different story. According to economists, there's a 48% chance of a recession within the next year, while consumers, representing Main Street, estimate a 69% chance. CEOs, however, are the most pessimistic, with 84% predicting a recession. Why are CEOs more concerned than others? They likely understand the financial pressures their companies face. Many corporations took on debt at lower interest rates, and when these debts mature, they'll be forced to refinance at much higher rates. This looming debt crisis may explain why CEOs are bracing for economic turmoil, while the general public remains cautiously optimistic. A curious phenomenon has emerged in the stock market. 7 companies, Meta, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla, make up a staggering 28% of the S&P 500 index. Historically, no such concentration of wealth and influence among so few companies has ever occurred. This concentration creates a distorted picture of the overall stock market's health. If you remove these 7 companies from the S&P 500, the index would actually show a decline for the year. These tech giants are masking the struggles of smaller companies. While the S&P 500 is up roughly 12% year-to-date, the Magnificent Seven are up around 92%. In contrast, if we examine small and mid-cap companies, the picture looks much bleaker. For example, the Russell 2000 index, which tracks smaller companies, is up only 7%, and the microcap sector has declined by 1.85%. This discrepancy reveals a deeper issue. The success of a few large companies is propping up the market, while smaller businesses are struggling to stay afloat. The rich get richer, while the small players face increasing challenges. Consumer debt and the credit card crisis. Another red flag for the U.S. economy is the soaring levels of consumer debt, particularly credit card debt, which has surpassed $1 trillion for the first time in history. This alone might not seem alarming, given that Americans have been using credit cards for decades. However, the real problem lies in the rising interest rates. As the Federal Reserve increases interest rates, credit card interest rates follow suit, making it more difficult for consumers to keep up with their payments. Today, credit card interest rates are higher than ever. This is especially problematic for those already carrying high balances, as their minimum payments continue to rise. The burden becomes unsustainable for many households, leading to missed payments and defaults. On top of that, the government's student loan forbearance, enacted during the COVID-19 pandemic, is coming to an end. Millions of Americans will soon have to resume payments on their student loans, adding another financial strain. For many, this extra $300 per month could be the tipping point that leads to further economic distress. The housing market and mortgage rate dilemma. The housing market is also showing signs of stress. Mortgage rates have climbed to over 7%, with some even reaching 8%. While this increase affects those looking to buy homes, the average mortgage rate across all borrowers has barely increased. Why? Because many homeowners secured loans at lower rates during the pandemic and are holding on to them for dear life. People are hesitant to sell their homes and face the prospect of a higher interest rate, so the housing market remains relatively stagnant. Few new buyers are entering the market, and those who do are facing significantly higher borrowing costs. This dynamic has kept the housing market afloat for now, but how long it will last is uncertain. The lag effect. When will the recession hit? One of the most important indicators of an impending recession is the so-called lag effect of interest rate hikes. Historically, it takes about 11 months from the time the Fed stops raising rates for a recession to hit. Based on current trends, if this pattern holds, the United States could face a recession just before the 2024 election. Many corporations are also teetering on the edge of financial trouble. During the era of low interest rates, companies borrowed billions of dollars, often locking in favorable rates for 3 to 5 years. However, as these debts mature, they'll have to refinance at much higher rates, significantly increasing their financial burden. The example of WeWork, a company once valued at $47 billion that recently defaulted on a $95 million payment, serves as a cautionary tale. Many more companies may follow suit as their debt obligations come due, potentially leading to a wave of corporate bankruptcies. Corporate debt. A looming crisis. Corporate debt is another looming crisis that could trigger a recession. In 2025 alone, $1.1 trillion in corporate debt will mature. By 2028, this figure is expected to rise to $1.3 trillion. Many companies are already struggling to make their debt payments, and when interest rates reset to higher levels, it could be catastrophic. This growing debt burden is one reason why CEOs are so pessimistic about the future. They know that their companies may not be able to handle the higher costs of borrowing. As corporate bankruptcies increase, the broader economy will undoubtedly feel the ripple effects. Government debt. A national concern. While consumer and corporate debt are concerning, the United States government's debt is even more alarming. The national debt stands at approximately $33 trillion, and each 1% increase in interest rates adds $320 billion to the government's interest expenses. If rates continue to rise, the government's debt burden will grow, making it increasingly difficult to fund essential services and programs. What lies ahead? As we navigate these uncertain economic waters, one thing is clear: The United States economy is at a crossroads. While the stock market may appear healthy on the surface, the underlying problems are becoming harder to ignore. The Magnificent Seven companies are masking the struggles of smaller businesses, and rising consumer debt, coupled with soaring interest rates, is putting enormous pressure on households and corporations alike. The lag effect of interest rate hikes suggests that a recession may be just around the corner. Whether it hits before or after the 2024 election remains to be seen, but the warning signs are there. Only time will tell if the United States can avoid a significant economic downturn. But as history has shown, it's often the paranoid who survive such turbulent times. Thanks for watching this video. Please hit the subscribe button and give this video a thumbs up.